Okay, let's take a few minutes to run through some of the ratios we can look to analyze a company's financial statements, and it also helps us compare companies as well. So we can use these ratios and take two unequally sized firms and go ahead and to do an analysis of their financials and see which one looks stronger. So if you were going to do some investing, you might want to review some of these ratios and compare different companies to see which one has a stronger financial background. So the first one we'll talk about real quickly is called working capital. And working capital is simply defined as current assets minus current liabilities. And it's a critical measure for all types of businesses. Positive working capital means the company will have enough assets converted into cash within the next year to pay its current obligations. So again, we like to make sure that the company has enough after they pay their current liabilities to perhaps do some investing in the company long term. So a higher number would be better there. Current ratio, this is perhaps the most significant measure of a company's ability to pay current obligations. It's simply calculated by dividing the current assets by the current liabilities. And you can see here in this example, we've got a ratio of 1.55 to 1. That means for every dollar of current liability that the company has, they have $1.55 to pay that obligation in current assets. So typically the rule of thumb is we want at least $1.50 in current assets to pay every dollar in current liabilities. 2 to 1 is even better, $2 to every one. The asset test ratio is a more stringent measure than the current ratio, and we calculate this ratio by dividing quick assets by current liabilities. So quick assets include cash, our marketable securities, current accounts, and notes receivable. So in this particular example, you can see that quick assets are cash, short-term investments, and current receivables. Short-term investments might be 90-day treasury bills that can be easily converted into cash. And their asset test ratio comes in at 1.19 to 1. So that means they have $1.19 in quick assets, those that can be quickly converted into cash, for every dollar in current liabilities. And the ratio we look for here is going to be a $1 1-to-1 ratio. So $1 in quick assets to every dollar in current liabilities. Another ratio we can look at, not as commonly used, called the cash flow liquidity ratio. We take the cash and marketable securities plus the net cash provided by operating activities. That's going to come from our statement of cash flows, the operating activities section, and divide it by our current liabilities. So here we're using the most truly liquid assets, so even more stringent than what we might find in the asset test ratio. Accounts receivable turnover ratio is calculated by taking our net credit sales on account and dividing that by our average accounts receivable. And the way we calculate an average in this class is pretty straightforward. We just take the beginning balance plus the ending balance and divide it by 2. So in this case, the accounts receivable turnover ratio is 26.7 times, which means that on average, accounts receivable turns over completely almost 27 times a year. That'll give you an idea of how many times a company converts its accounts receivable into cash. The higher the turnover ratio, the faster the cash collection. Now, we can take that a little bit further because you might say 27 times a year doesn't make a lot of sense to me. We can see how many days on average a receivable sits on the company's balance sheet. So you take 365, the number of days in a year, divided by that accounts receivable turnover ratio we just calculated, and that'll get you the number of days in accounts receivable. And a lower number then is better there because we want to turn it over. We want to collect our receivables faster. We can do something similar here with inventory turnover. So inventory turnover is calculated by taking our cost of goods sold for the period divided by average inventory. And again, don't forget, average is the beginning plus ending divided by 2. So in this case, the inventory turnover ratio comes in at 12.73 times. So inventory for this company is going to be turned over roughly 13 times a year, a little bit more frequently than once a month. That's how many times they buy the item, they put it on the shelf, and it gets sold. Companies prefer to have a higher turnover ratio. That's going to help protect them from having damaged, obsolete inventory items. Also, it costs money when an item sits just on the shelf. So the faster we can turn over that inventory, the better off we'll be. Total asset turnover is equal to taking your net sales divided by your average total assets. This will tell us in general how good is the company at generating sales with the assets that it has invested. So it's a measure of efficiency in producing sales. Again, we can take two unequally sized companies then and see which one does a better job at generating sales with the assets they have. Equity ratio. We take our total stockholders' equity divided by our total assets, and that will give us a ratio of how much of our company's assets are contributed or are paid for by our investors. And it's as it says here, helps us determine solvency and safety. So a higher number here means less of the assets are financed through debt. So, and that is somewhat similar to what we're seeing here. A measure of the company's stockholders' equity in relationship to total debt. So we get what's called a debt to equity ratio. Ratio of return on operating assets is simply calculated by taking net operating income divided by net sales, and that will give us our operating margin. A higher margin is always desirable. It's just how much of each dollar in sales actually comes in the form of net income. So again, we like to see a higher number there. Return on sales is just net income divided by net sales. How much of every dollar sold is actually profit? Cash flow margin. Take your net cash provided by operating activities, which would come from our statement of cash flows, divided by net sales. And that'll tell us how much of our sales come in the form of cash. Basic earnings per share. This is a pretty commonly referred to ratio, actually. And the way that it's calculated is by taking net income minus the preferred dividend. So we back out the dividends paid to our preferred stockholders, and we divide it by a weighted average common shares outstanding. So you'd have to see how long each amount of shares was outstanding during the year. Typically, companies don't change this a lot, so it's really not as complicated to calculate as you might think. So in this case, its net income was this amount, and they divide it by the number of shares outstanding. That tells them the company earned $1.96 in income per share of stock outstanding. A higher number tends to be looked upon more favorably. The issue I have with this specific ratio is a little hard because different companies have different amounts of stock outstanding. So it's a little harder to compare from one company to another. But again, if you're going to be an investor, it is one of the most widely quoted financial ratios, and you would want to look for a company that has a high earnings per share in general. Times interest earned ratio. This gives us an idea of a company's ability to meet their periodic interest payments. So it's calculated by dividing the net earnings, net income before interest expense and income taxes. So if you have a net income number that's after interest expense and taxes, you have to add that back. Divided by the interest expense. So this particular company can pay just the interest on their outstanding loans 11.51 times. So again, higher number would be better. Times preferred dividends earned ratio. Take your net income divided by the annual preferred dividends, and it tells you the likelihood that stockholders will receive their dividend payments. I don't see that one used too much. Earnings yield on common stock. Take your earnings per share divided by the current market price of the stock, and that will give you a yield. You also see something used more commonly called the price earnings ratio. And here you take the market price divided by the earnings per share. And this company has a 7.65 times. So the stock is trading at 7.65 times the actual earnings per share. So when you see a company that has a higher earnings per share ratio, price to earnings ratio, that's telling you that the stock market looks very favorably upon that company. So if, in particular, if you were comparing two companies, you can see which one the market thinks more highly of. Now, you'll also find some people that think they want to find a stock with a low price to earnings ratio because there's more room for growth, and perhaps they think the company's going to do better over time than the market does. I'm not that smart. I tend to go with what the market thinks, but that is another strategy some people use. Dividend yield, you take your average dividends per share divided by the market price per share, and that will give you a yield. So it tells you in general, if you find a company that has a higher return, that would be preferable because you want to get a high return on your investment. So a higher dividend yield means you'll get your money back faster. Cash flow margin, net cash provided by operating activities divided by net sales. I almost feel like we saw that one. But also, we have what's called cash flow per share of common stock. Take your net cash provided by operating activities divided by the average number of shares outstanding. It'll tell you how much cash is coming in per share of common stock. I don't see that one used very often, or the cash flow margin one. Here's something, though, this is pretty important. So when you're doing your financial statement analysis, what are some things that perhaps might give you concern? And some red flags that decision makers might recognize and encourage you to maybe do a little digger deep into the financial statements to see what you can find. So if a company has decreased cash flow, that means cash flow from operations is starting to go down. And so the question is why, and might that encourage the company to at some point get a cash shortage? So that's something you might want to worry about. Inability to collect receivables. So again, if you see a company who's starting to, their receivables is growing and their cash flow is falling, that's a very big red flag. The A. Stein Meets video from CNBC's The Profit will show you very quickly what happens to companies that aren't collecting on their receivables. A buildup of inventories. Again, that's a problem because perhaps the company is not selling anymore. So their inventory levels are starting to build up. And if you're not selling your inventory, you're not going to make money. And again, it costs money to have inventories just sitting there and not selling. So in general, movement of sales, inventory, and receivables are all things that you want to look for. Earnings problems. So the company has decreased net income for years in a row. That might be a trend that we're not looking forward to because you can't have consecutive losses year over year over year. And then finally, too much debt. Now this one you have to be careful because different industries will run, in general, different debt levels. But in general, if you see a company that has too much debt, as you all know, and you get a lot, it gets really hard to get out from under that debt because you're saddled with so much in interest payments and other things that it makes it just really difficult to get out from that. So something else to look forward to. And that's it.